You know, when you're investing for retirement, you run into this classic problem, right? How do you actually grow your money without putting it all on the line? It's this constant tug of war between growth and safety. So in this explainer, we're going to dive into two types of annuities that were literally designed to try and solve this exact problem. I mean, isn't this the million-dollar question for pretty much any long-term investor? We all want that sweet upside from the stock market, but man, the fear of a big downturn wiping out what you've saved, that is very, very real. This challenge is precisely why the products we're about to talk about were even created. So let's dive into what's often called the investor's dilemma. It's that feeling, that tension between wanting the huge growth potential you see in the market and at the same time wanting to protect every single dollar you've worked so hard to put away. Right, and this is that classic trade-off, isn't it? For the longest time, it felt like you just had to pick a side. Are you team growth or team safety? But you know what? The world of annuities has evolved. It started to offer these hybrid approaches that try, and I mean really try, to give you a piece of both. Let's see how they do it. All right, so first up, we've got a really fascinating solution, the equity indexed annuity, or you'll hear it called an EIA. The best way to think about it is like an attempt to build a safety net right under your investment, letting you get a taste of market growth, but with this built-in layer of protection. Now, the key word here, the most important word, is linked. Your interest rate is tied to how an index like the S&P 500 performs, but, and this is crucial, your actual money isn't invested in those stocks. It's kind of like you're betting on the game from the sidelines instead of actually playing on the field. That separation is the magic trick for how it offers both potential growth and safety. So you're probably wondering, how on earth does this safety net actually work? Well, the insurance company takes most of your premium and puts it into something super safe, like high-grade government bonds. This super conservative investment is what backs the guarantee on your principal. It's what lets them promise you a minimum return no matter what, even if the stock market totally tanks. So there it is, the big promise. A taste of the good times when the market's up, but with a floor so you can't lose your principal if it goes down. It's a really powerful idea. But of course, nothing is free. That protection comes with a trade-off, and it has to do with how much of the market's gains you actually get to keep. And this is the catch. It's called the participation rate. In exchange for protecting you on the downside, you don't get 100% of the market's gains on the upside. So for example, let's say the S&P 500 shoots up 10%. If your contract has a 70% participation rate, your account gets credited with a 7% gain, not the full 10. That's the price you pay for security. Okay, let's switch gears completely and look at another way to tackle this investor's dilemma. This one is called a market value adjusted annuity, or MVA. Now, instead of linking to the stock market for growth, this product is all about locking in a specific, guaranteed interest rate. The idea here is pretty straightforward, actually. You give the insurance company a lump sum of money, and in return, they promise you a fixed interest rate for a set number of years, say 5 or 7. It's a lot like a CD you'd get from a bank, but, as that name implies, there's a little market value twist if you need to get your money back early. This is so important. If you want to get what an MVA is all about, you've got to think of it like a bond. Why? Because just like a bond, its value moves in the opposite direction of what's happening with interest rates out in the market. It's like a financial seesaw. Seriously, if market interest rates go down after you've locked in your awesome higher rate, hey, your annuity just became more valuable. But, and here's the risk, if market rates go up, your locked-in rate suddenly doesn't look so hot, and the cash-out value of your annuity actually falls. So what's the bottom line with an MVA? Well, the risk you're taking on isn't the crazy ups and downs of the stock market, it's interest rate risk. And unlike a traditional fixed annuity, the insurance company is shifting that risk from their shoulders right onto yours. So you might be asking, why would I ever take on that risk? Well, the carrot they dangle is often a higher guaranteed interest rate than you'd get otherwise. The catch, though, is that if you need your money before the term is up, you're going to face that market value adjustment, which could be negative. And on top of that, probably a standard surrender penalty fee, too. Okay, so we have two totally different approaches to balancing risk and reward. One is trying to solve for stock market risk, while the other is all about interest rate stability. Let's put them side by side to see how they really stack up. This chart really breaks it down for us. Just look at that principal risk row. That's the whole story right there. With an EIA, your principal is protected from the stock market going down. But with an MVA, the value can fluctuate if interest rates change and you need to get out early. This is the core trade-off. Your decision really comes down to which goal fits you better: safety from the market with some growth potential, or a guaranteed rate for a set period of time. All right, let's bring it all home. When you're trying to choose between these two, it really boils down to one simple question. What kind of risk are you most worried about?
Let's just put it as plainly as possible. EIAs are your shield against a stock market crash, but the price is that you cap your potential gains. MVAs give you a predictable rate you can count on, but their cash-out value can take a hit if interest rates rise. So the choice is yours. Are you more interested in managing stock market risk or interest rate risk?
And that's really the question you have to ask yourself. When you think about your money, what worries you more? The volatility of the stock market or the shifting sands of interest rates? There's no single right answer here. It's all about your personal outlook and, at the end of the day, what helps you sleep at night. Thanks for tuning in.